Thanks for joining us, and don't forget to hit the subscribe, the like, and the notification button for more.
Hello, everybody. Kevin Wadsworth with me, Patrick, and Don Durrett, none other than goldstockdata.com. I'm super happy, man, Don, to talk to you. I think you were one of our first guests back in the days, and your point of view is super, super welcome. So let's get down into it there. Who's wrong and who's right?
Well, Patrick, thanks for having me on, Kevin. This is our third time together. Yeah, I think I was one of your first guests. You guys have been doing a great job.
Thanks.
Thank you very much. Thanks. We do our best. Okay, well, we were talking before we started recording there, and talking about general equities, the S&P, some calls that various analysts have made recently for general equities, and as you say, Wall Street as well. Some big Wall Street firms calling for some big moves up in general equities and stock markets generally. A bit of a melt up is being called for by some people. What's your view?
So since last October, when this thing started, the market started rolling over, we've actually had 4 rallies that have failed. So kind of 4 dead cat bounces. I think this is the fifth one. And I think this is going to be the big one, if you will. I don't think for a moment here that the lows are in. The real bad news hasn't come yet. I mean, you think about back in 2007-8, when we basically went into a recession, we had some huge bad news, right? We had Bear Stearns, we had Lehman Brothers, huge bad news, right? We haven't had any bad news. This has basically been an inflation-driven, kind of market drawdown. And Wall Street, they don't think bad news is coming, but when these rate increases that we've had, those have to be digested. Plus, we have more raises coming. So, I think there's almost 100% chance they're going to raise in September. So we got that one we have to digest, and that's probably not the last one. They could raise 1 or 2 additional times. November, October, November, December. We could see even additional raises. So those have to be digested. So the economy, I don't think the bad news is we've had it yet. I think the really bad news for the economy is coming. And when that bad news comes, I think Wall Street's going to wake up to the fact that we have a serious problem here. It's not going to be, this soft landing where, the Fed just starts lowering rates and injecting money and brings the economy back to growth and everything's basically back to normal. I don't think the U.S. economy is going back to normal. I think this is a transition period into the worst economic environment the U.S. has experienced basically since the Depression. Because even if you go back to the 70s, which were, the time of malaise, and then I think that's really the last time all the way back to 82. So you go basically the 70s all the way through 82. That was kind of the worst of it. When America basically felt like, how do we get out of this, this slump? I think this is going to be worse than that, because once we go into this, I call it muddling. It's not going to crash. We're basically going to kind of experience what Japan experienced in the 90s, where you just get no growth. There's just no growth. And in the Fed, in the Treasury, they can do stimulus, they can do whatever they want, but it's just not going to work. That's the same thing that happened to Japan. They did like 5 different, stimulus bills to get things going, and nothing worked. And then finally they gave up on the stimulus bills, and they just basically started buying bonds and keeping the rates low. And they stopped with the stimulus because it didn't work. It's like so the same thing's going to happen to us. We're going to do stimulus bills. They're not going to work. Nothing's going to create growth. We're going to get stagflation. It's going to be nasty. And I think that all starts here in Q4, Q1, where we start to recognize we have a problem.
So I'm just going to whilst you're just talking there, Don, I'm just going to share the chart for the S&P. Hopefully,
yeah. Can we see those? Can we see those dead cat bounces? Can we have to look at the week. We're gonna have to look at the weekly to see.
Yeah, sure.
Let's look at this. I'm sorry to interrupt. Let's look at this first, and then we'll look at the weekly.
Okay. Yeah, I was just putting it in perspective in the broader picture, just to kind of give it a little bit of context to what you're saying there. And we kind of built out this large bearish rising wedge over many decades, in fact. And you can see how that bearish rising wedge broke down only to build another one beneath the original bearish rising wedge. So just to kind of finish up on this monthly chart here, it depends a little bit on this support line, just exactly how you envisage that support. But you could just position the line something like that, which gives a pretty bearish look to it, because all you're doing is back testing the basically the meeting point of those two support and resistance lines. But you could just position that line also around about here as well, where S&P bounced off the line, bounced off it here temporarily, broke through in March of 2020, and then went on to again test the previous support, now resistance from underneath. That being the case, of course, we're resting right on that pretty critical support line there. So as you say, we are at a pretty important juncture right here. And if you go onto the weekly and you want to sort of look at that in a bit more detail, there you go.
Yeah, and it's interesting that you've drawn your line here and you're calling this kind of a critical level, because I don't think we're going to get above 4,200 here. So we're kind of really close to this line that we're going to go back and it's going to falter. It's going to go through it. It's going to go through it for when the bad news comes. We're going to go through that line significantly. Right? We're going to go down to 35. I think we're going to go to 33.35. 3,300 to 3,500 is where I think we're going. And then if it doesn't hold, then we go down and we test 3,000. But I think 3,000 holds. But my target's 3,300 to 3,500. That's going to be the low. And then once we hit that, it's going to be, a nightmare to grow out of it. Basically, we're going to go down so far that there's not going to be a driver to pull out of the mud. Basically, there you go. There it is right there. That's where we're going between, 3,300 to 3,400, 3,376. That's it. Put a big yes, and then possibly 3,000. No, we're not going to 2,600.
But the trouble is, I suppose, once you get that kind of
downward, that 3,376, absolutely, that's where we're going to go. I think that's the bottom right there, and it's going to be low enough that we just can't get out of the mud. There's just nothing to pull it out. To go all the way, then we have to go all the way back to 48.18, and it's just not going to happen. And so you're going to get into this nasty up and down, can't move, and then finally, people are just going to get fed up with waiting, and just So let's look at since October. So let's just look at the last year. You can just look at the last year. And I mean, we might even have to go to the daily on the last year, but I think weekly works. But we can look at these dead cat bounces. Okay, there you go. Now we're getting somewhere. So go to October. You'll see the first. Okay, so you'll see the first one. So right there in September. Okay, there you go. So yeah, so you got that one. You start seeing the rallies. Here's your rally, and it didn't work. Right, down. You have another rally, down. Another rally, down. So we've had a lot of these rallies, and every single one of them has failed. And this is going to be the worst one. Up and down, up and down. It's not, it's not off to the races here, people. This all started, back in October when the first faltering. So we fell in October. We tried to get out of it in November. It didn't work. You can see, and here we are. This is the fifth one, and it's going to falter. This is going to be the worst. I think this is going to be the worst one. And if you notice, every single one of these dead cat rallies have led to lower lows, right?
Kev.
Yeah.
Don, close your ears, Don. I don't want you to hear this. Kevin, flip the chart and ask Don his opinion. Don, close your ears. Okay, you could listen now, Don. What do you think of this chart? Is it bullish or bearish?
It's yeah, it's nasty, right? Lower lows. And it's like, it's not, these bounces are not working.
So this chart is,
it.
go on. I'll let Patrick sort of what we've done here is obviously flip the chart upside down. So what we're drawing here is looking pretty bullish, but sorry, I'm looking down to the left hand. If people are wondering why I'm looking down at
there. That line, Kevin. Well, there's a horizontal line where you just drew it. 4,100 is. Well, right now, because I flipped the chart down, it looks like crazy support, 4,100, but that means it's insane resistance. So we're going to flip it back up. That's why, what's your top level? You said it's not going above
42. 42. That's right where the line draws.
Look at that. It's a wall.
Yeah, it's a wall. You get to 42 and then you go down to all the way down to my 33.76 and it's game over. It's game over.
So we're close, Don, to a turn.
That's the reason why, this is the reason why Wall Street are basically saying the lows are in. They're saying the lows are in because they know if they're not in, we got a problem. And I mean, the majority of people on Wall Street now say the lows are in, and they're just praying that there's no bad news coming. It's the same thing with the Fed. The Fed is praying and hoping that inflation goes away on its own, right? Basically, everybody's saying that inflation has peaked, interest rates have peaked, everything's behind us. They're all on hopium. They're all on hopium. They're just hoping and praying that these things happen, that inflation's peaked and that it's just going to start trending down, down, down. Everybody's saying that, we're going to 3% inflation in Q1 of next year, everything's going to start going down. The truth of the matter is that inflation is going to be a minimum of 5%, over 5% in December. So from now until the end of Q4, it's almost impossible to get below 5%. So we're going to start the new year at 5%. That's not a good number. So they're going to start at 5%, and then simultaneous to the 5% number, in my opinion, that's when the bad news is going to start leaking out, or the bad news is going to start appearing. So you have a combination of 5% inflation. And who thinks 5% inflation is good? It's not good. 5% inflation is a serious number. See, and I'm talking about the government number. So the government number is going to be 5% January 1st. What's the real number going to be? The real number is around 8.
You have to ask yourself as well, when people are giving their views on inflation, the people who are saying it's going to be 3, 4, 5%, are these the people that told us it was going to be 9%? Because if they're not, why are we even listening to them? If they can't call 9%, why do we expect them to be right when they call 3, 4, or 5?
Yeah, I mean, Wall Street is actually giddy that inflation is going to go to 3% and that everything is going to be fine. When we get inflation at 3, then we get the 10-year down to 2, and everything's fine. And then basically MMT is back in motion. This is the one thing that really is interesting to me, is that it is MMT, and nobody really talks about it. So, I mean, I started analyzing the stock market in 1980. I'm 62 years old. I don't look 62, but I am. So I started analyzing the stock market in 1980 when I was 20 years old. And I've been following it ever since. And basically what has happened in this country is we have transitioned from the 1980s. We basically Reagan went into this idea of using Keynesian economics during periods of growth. And George Bush called it voodoo economics, because he was basically increasing the debt during a period of growth. And in 1988, when, he called it voodoo economics when he ran it, and so it's like, why was he calling it voodoo economics? Now it's even worse than that. So I call it more of a Potemkin economy now. It's all it's all a facade of strength. So voodoo economics now, MMT is basically, if you take the Keynesian economics of the 80s, we transitioned now through the 90s. So we got into the 90s for a little history lesson for some people. We went into the 90s, and Newt Gingrich came into power, and the Republicans came into power in the early 90s. So 92, Clinton won the election, but he didn't control Congress. The Republicans did. Newt Gingrich was basically the power in Congress. And Newt Gingrich decided that all that voodoo economics was bad, and that we need to stop this debt explosion. So you go back to 1980, the government had $1 trillion in debt. Well, by the time we got to 92, it was up to over 3 trillion. I think it might have been over 4. Reagan left office, it was 2.7. I think by 92, I think we were up to over 4. And Gingrich was basically saying, this isn't working. We need to balance the budget. He came up with his contract with America, and the whole focus was we're going to balance the budget. And Clinton went along with it because he didn't have any power to really stop him. And so we balanced the budget. So we went through the 90s, and it was basically a fight against debt, a fight against this so-called, voodoo economic philosophy of increasing debt. Debt's, basically the Republicans said debt is bad. We're going to balance the budget. And so that all broke in 2001. So in 2000, we had the dot-com bubble pop. And then in 2001, we had 9/11. So those are the back-to-back. Both of those broke the back of the U.S. economy, because at that point, we could no longer grow without basically this voodoo economics. Basically, we had to stimulate it through debt. But at that time, in early 2001, the Fed wasn't really on board yet with going to MMT, which was happening in Japan. Japan was basically exploding their debt. The Fed wasn't really on board yet. They didn't get on board until they started stimulating, but they didn't go crazy. It was basically moderate. It was very moderate. Bernanke, he really wasn't ready to flip the switch yet. It wasn't easy to flip the switch because remember, we actually balanced the budget in 99. We balanced it. So we're not going to go hog wild 2 years later, right? So Bernanke slowly, he did the stimulate, he lowered the taxes. So he did part of MMT. Part of MMT is lowering taxes. The other part is injecting money. But he didn't really inject it that's hard yet. That happened in 2007 and 8. Hank Paulson was the Secretary of the Treasury. He wasn't part of the Fed. So the Fed was over here on the sidelines still. They hadn't really adopted MMT. But Paulson came in and said, look, the whole thing is going to burn to the ground if we don't bail out all these. Basically, we bail out the banks, we bail out the investment banks, and we bail out some of these insurance companies. And that's what they did. And the Fed basically changed their tune after Paulson, and they basically got on board with MMT. And so that's what we have today. So then from 2008, nobody really believed that the Fed was going to basically backstop the economy with this injection of money. So there was still a little bit of uncertainty of what the Fed was going to do. So from 2008, the economy came back to life in 2009. And then from 2009 to 2011, gold went crazy. The reason why gold went crazy is because people were still nervous about what's going to happen here. Is the whole thing's going to melt down. But it didn't melt down. And so we got to 2012, we peaked out, and then gold started crashing from 12 to 13. And that's when the Fed basically said, don't you worry, we're going to backstop the economy. We're going to backstop we're going to inject money. We're going to lower rates. Remember, inflation was dead. We're basically going to backstop the stock market. We're going to backstop assets. We got your back. So that changed the whole mindset of Wall Street. And the mindset was, we got it. We got this new economic philosophy where debt doesn't matter. We can have $2 trillion deficits doesn't matter. 1 trillion is nothing. We've had zero talk since 9/11. We've had zero talk of lowering deficits. Zero. It went away. We went into this new mindset of MMT that debt doesn't matter. And now here we are today. So basically it was an experimental economic philosophy that debt doesn't matter. And basically we can expand the Fed's balance sheet. Now it's up to 9 trillion. In 2001, when that happened, the Fed's balance sheet was 1 trillion, same as Reagan in 1980, 1 trillion. And now it's at 9. The federal government's balance sheet, now we have two. So you have the Fed's balance sheet exploding, which happened in 2020, right? Nobody cares anymore. Nobody cares about debt. So that's where we're at today. And that's the reason why I'm going on and on and on about this is that this is the risk that everybody's ignoring. This is the underlying risk that's going to drive gold higher. And once this bad news pops up, which I'm saying is coming, that's going to create the fear trade and gold's going to start running. But we're not there yet. We're right around the corner. We're really close.
If you had your best guess, I know it's like I'll give you 3 guesses. What do you think the black swan is?
Yeah, I think there's a couple. My first one is Ukraine. Ukraine basically, I think, changed the whole dynamic of international trade. And international trade is huge, right? And I think it changed the whole dynamic of international trade. I think that if you read the book by Brzezinski, The Grand Chessboard, the guy was brilliant. The guy probably understood Europe and Asia and Eurasia and the United States interaction with it better than anybody. And that book it's so well written and so eye-opening. And he wrote this thing prior to 2010. And he basically says over and over and over in that book, he must say it 10 times, that Ukraine is the most important country for Russia's national security. Don't mess with Ukraine. But Ukraine is a pivot point, a trigger point for the whole Eurasian change. What's going to happen in Ukraine is probably going to determine the future of Eurasia. And here we are, the U.S. basically after the Berlin Wall fell in 1989, there was a meeting in Europe, with Russia, because they were trying to figure out, what's going to happen with there's a lot of change here, right? The Berlin Wall falls. And there was a meeting in Europe between the United States and Russia, the leaders, right? And basically the whole meeting was about NATO. What's going to happen with NATO? You guys we don't want you, if all this stuff falters, we don't want NATO to basically, take over all these countries and expand to our border. That was a big part of this meeting. Russia was basically going, look, you guys have NATO. We're going to be over here isolated. We don't want you guys to surround us. And we gave them our word. We weren't going to expand NATO, which was a flat out lie. And then not only did we expand NATO, but Ukraine, we were getting ready to literally move into Ukraine and have Ukraine join NATO. And Russia basically said, no, that's not happening. And Brzezinski basically said, there's no way that Russia will allow that, because Russia really doesn't have any allies. If you look at where Russia is situated, if you look at the countries around them, a lot of those Muslim nations don't really trust Russia. They're not strong allies with Russia. They consider Russia as the big bully. And so they don't trust them. The only countries that really trust them is Belarus, and Ukraine until 2012, 2014, and now Ukraine. So that was, as far as Putin was concerned, Putin has lived through this whole thing. Putin is in the same mindset as Brzezinski. He's basically saying, look, Ukraine, we have to have Ukraine. It's our most important ally. You guys can't take it away from us. So now, I think the U.S. basically kind of instigated their own downfall here, because now Russia has allied with China, which they're natural enemies. How in the world do we take, the thing that's odd is that the United States and Russia are actually natural allies. We fought together in World War I and World War II. We're like natural allies. And Russia and China are like natural enemies. Why are they natural enemies? Because China wants to expand their influence into these Asian countries, and Russia doesn't want them to. So they're fighting over basically influence in these areas. And so they're natural enemies. And here they are we're turning them into allies, which is bizarre. And so now we've created almost, kind of the perfect scenario for the US's downfall, which is the BRICS plus. So you take the BRICS, which already had Russia and China allied economically, and now it's expanding to include, it's already included Mexico, it's included Iran, included Indonesia. These are big countries, and Argentina. And now Saudi Arabia hasn't joined yet, but they're talking about it. So the BRICS plus is basically an economic alliance to bypass SWIFT and bypass U.S. influence. This is what I think is going to be the trigger. I think it's going to happen in the next, say, 1 to 6 months, where this BRICS plus announces the currency they're going to use. Well, first they announced the system. They basically announced this financial banking system that allows them to transfer money across borders. And then they're going to announce the currency they use. That to me is probably the number one black swan. The other black swan is oil. So you got oil and energy, and then oil and energy, I think right now, like oil's under $100 and people think it's going to go down to 80 or lower because we're going into a deflation. Well, newsflash, Russia, Asia's not going into a recession, so they're going to need oil. They're going to be basically growing. I don't see them going into a recession. And then Europe, I think they might go into recession, but it's not going to be a serious recession, so they're going to need oil. The only country that's really going into a serious recession is the United States. And our oil consumption is not really going to crash. And the economy is not going to crash, I don't think. So I don't see this huge drop in oil. So I think oil is going to probably go back up to 120 once people realize that there's not going to be demand destruction for oil per se. So oil, and then the last black swan for me is mass layoffs and basically a black swan in finance, some type of liquidity issue, basically a Lehman twin type of situation where you get basically a Fed comes and has to bail out somebody, but you start to get this liquidity crisis, financial crisis. People are also talking about Japan having some type of a meltdown because their currency is getting really strong. So you get this international fallout. But there's a lot of black swans that are looming here, I think.
Of course, there's China and Taiwan as well, which is always bubbling away in the background.
Yeah, that one's another one. Absolutely. That would be the ultimate black swan.
yeah. It's and that's another case where the US seems to be stirring a hornet's nest at the moment, and not entirely sure why they're seemingly intent on making matters worse.
Jesus. Hey, Don, what are the odds of Canada joining BRICS? Could that ever happen?
Zero. So yeah, Australia, the US has certain allies: Britain, Israel, Canada, Japan, Australia, New Zealand. Those are US's mainstays. They're not going away. The only one that's kind of a risk, and Brzezinski talks about this at length, is that Japan, they will be an ally of the US, but only to the extent that it doesn't harm them in Asia. If it gets to the point where their association with the US is harming them in Asia, they'll back off, because Asia is more important to Japan than US.
Makes sense. I was wondering, Don, what do you think about this recession thing there? According to your, do you think we're in a recession right now, or
definitions seem to be changing, don't they? Of what a recession actually is.
Yeah. So I think that you have to use the 2-quarter GDP down as a recession, but you can have very light, short recessions. We had one in 2020.
Yeah.
So, I mean, if we have growth this quarter, yeah, we had basically a 2-quarter recession, but it was very light, right? Wasn't serious. We came right back out of it. So there's different degrees of recessions. You can have, Yellen basically says there's no such thing as a light recession. It has to be, a recession is serious, ramifications to business, inventories and business demand and all. I call baloney on that. You can have a light recession that doesn't last very long, and some businesses are unaffected, right? But I think that the more serious recession is coming. The bad news is coming. I really don't think that the recession has started yet. The one that I'm accepting. But simultaneous to that, there are a lot of small businesses right now who are hurting because of inflation. And if you ask them, yeah, I'm in a recession, I'm barely hanging on because the consumer's not spending any money here. So you saw a lot of small businesses are hurting. They'll tell you they're in a recession. You have a lot of businesses whose growth is very, very sluggish. They'll tell you they're in a recession. So, it depends what business, depends on who you are, but definitely the economy is sluggish right now. I don't think anybody can deny that. As a matter of fact, let's go down the list, right? Housing. Is housing growing or slowing right now? I think it's slowing. Retail. Is retail growing or slowing? I think at best retail is flat. PMI's manufacturing. Is it growing or is it slowing? I think it's flat, right? So those are some big sectors. How about vehicles? Vehicles, autos. Are they growing or are they flat? Who knows? But it's not great. So I think if you look at the macro picture, if you look at the big industries, if you try to tell me, which sector is strong at the moment, if you look at the high tech industries who have basically driven Wall Street, they were all basically missed last month or last week, so they're not doing great. And so who's doing great? I think government jobs, are not doing great. That's another one that's. So on the whole, I think, if we're not in recession, it'll do until we get there.
There's something I just wanted to touch on, Don, and I don't know if it's quite the same in the United States or even Canada, but here in Europe, I'm sitting here in the UK, and I know particularly in Germany, we've got a massive issue with energy costs, and it's an energy crisis. I don't think it's understating it to say that we're on the verge of a complete crisis in the European Union. And I'll give you an example. Myself here in the UK, average consumer of gas and electricity, my home energy costs were about 1,200 British pounds a couple of years ago, maybe 18 months ago. They then went up to £2,000. They went up to £2,500. They then went up to £3,000. They're currently sitting at £3,600, and I've received notice that they're going to go up 60% to £5,000. So that's an increase from just over £1,000 to £5,000 in 18 months to 2 years for just to heat and light my home. Now, okay, that's not good for me, but I tell you what, the average British consumer is going to be crippled by that. And it's the same in Holland, it's the same in France, it's the same in Belgium, it's the same in Italy, it's the same in Germany. In fact, Germany is the European powerhouse, of course, European Central Bank, and Germany is, typically bankrolled the European Union, bailing, during all the bailouts that you mentioned earlier on, when Greece was bailed out during the financial crisis, money came through the European Central Bank via Germany, and Germany is, as I say, the powerhouse of economics in the European Union, and the powerhouse of stability. And their PPI, well, if you look at the graph, it's just gone straight off the top of the graph like a rocket. So we have a massive issue here, and I don't know what else is, all the stuff that you've discussed already is is going on in the background as well. But going into this fall, this autumn period leading into winter, the entire European Union is sitting on the brink of catastrophe purely through the complete inability of the consumer and industry to meet energy costs. So civil unrest is just a hair's breadth away from breaking out.
Yeah, I really like this question. And so we have the same problem here. So basically, you're saying that you're up to $5,000 a year, which is $1,200 a month, right? So you've jumped from $100, $200 a month to $1,200 a month for your utility bills. Is that what you're saying?
Oh, not that much.
Not quite that much. It's gone from £1,000, just over £1,000, and by October it's going to be approximately £5,000.
Right.
So it's gone up fivefold.
Right, but
that's about what, $7,000 a year, maybe a little bit more, $8,000 a year, I think.
Oh, okay, all right. Okay, my $1,200 a month was way too high, so it's more like
400, 300 or 400 per month.
Yeah, well, it's gonna be
it's much more than 400. It's much more than 400.
Yeah, it's going to go up to about £500 a month.
Right, you're right, Don.
Yeah.
So it's 7,000 divided by 12. It's 500, I believe.
Kevin, just ask for a pay raise. What's wrong with you?
580.
The point is that everybody's been so used to living on 0% interest, 0% finance, and zero growth in their bills, essentially food bills, energy bills. They haven't been going up for years. Right. Mortgages have been going down. Everything's been going down. So everybody is living to that limit. Right. As soon as things start to double, triple, quadruple in price, we've got a serious problem.
Right. So, yeah. So basically between $500 and $600 a month. So yeah, that's more than 2x, 3x what people are used to paying. So in the US, we're experiencing the same thing. And I talk about this, is that the middle class is basically going bankrupt. So the lower class is poor, always been poor, always paycheck to paycheck, barely hanging on. But we know that. Now the middle class is basically getting bankrupted as well. And so you just mentioned your utility bills going up 2x, 3x. You actually mentioned 4x.
Yeah.
Okay, so in the US, we're experiencing similar price rises. They talk about a 9% inflation rate, but the things that we actually need are going up much higher than that. I mean, if rates were really going up 10%, we could probably handle that, but they're higher. So, I mean, if you look at the main bills, you mentioned utility bills. So utility bills are going up more than 10%. There's no doubt about it, probably closer to 30%. Then you have rent. Rent has been going up anywhere, I would say on average, the average person is probably paying a 20% increase. Some people are paying 15, 10, some are 30, but around 20%. Then you have food, and food is up at least 30%, maybe not, up at least 20%, but a lot of people are paying 30%. So, it's basically a much higher than 10. Then you have gasoline, which people have to, in the US, we drive a lot more than you do. And that's up more than 20%. So if you look at the main bills that people have to pay, our inflation rate is really, and in the middle class, they pay more of their budget on these big items that they can't get away from. So your middle class, their inflation rate is much higher than, say, the upper class. People that have people that can afford food have a small percentage of their budget is food, versus the middle class, it's a higher percentage. Mm. So the middle class in the US, their inflation rate for this year is about 20%, at least 15. So let's say it's 15 to 20%. Well, a lot of these people are paying, they were already paying paycheck to paycheck. So the consumer is basically slowly getting squeezed. You talked about it in Europe, they're getting squeezed in Europe. They're getting squeezed here as well. So the consumer is the big kind of wild card, the big, you could call it a black swan.
I honestly think it could be, because don't forget that over here in Europe, and probably in the US as well, we've had maybe 10 years of what they called austerity. So we've had 10 years of pay rise caps. Anybody working in the public sector, government jobs, and of course that's hundreds of thousands of people, millions of people in the UK, pay rises have been capped at 1, 2, 3%, whilst inflation has been 4, 5, 6%. So over the last several years, pay has been eaten away by inflation already. And now that inflation is north of 10%, when you talk about what the real inflation, people are now being offered pay rises of 5, 6%. So we're losing huge chunks to inflation, and we're already seeing strikes breaking out. We've got the rail workers on strike. We've got teaching unions. We've got the medical staff. They're all talking about taking strike action. So I do see a lot of civil unrest and a lot of this could be one of many black swans that unfortunately may well occur in a similar time frame over the next few months.
Yeah, I just saw a chart that the pay raises and the rise in income has actually been decreasing. Of the ones decreasing on instead of going up higher, it's going up lower. Let me rephrase that. So let's say that earlier this year, when inflation first kicked into gear, before basically you started having the recession first, say the first quarter, say March, April, the pay increases were going up at a pretty good pace. I don't know if they were going up 5%, but somewhere around there. They were going up at a pretty good pace, basically. Well, that pace has leveled off because the recession is kicking into gear, and businesses are loath to give these big pay raises when they don't have income. So people aren't getting these big 5% pay raises anymore. So the average right now is dropped. The last chart that I saw, the chart is basically not keeping up with inflation. And because we're going to recession, I don't think people are going to get these 5% pay raises.
I think governments are also very cognizant of they have this idea, and quite rightly so, that of course when you get into this cycle of inflation bringing about increased pay demands and then increased pay rises feeding into inflation, you get this kind of snowball effect of sort of a self-fulfilling prophecy almost, where higher inflation causes higher inflation expectations and therefore higher pay rise demands, and then that feeds into the inflationary cycle. And I think that's also very much an analog of the 1970s as well. So maybe there's quite a large element of that, certainly from government pay bodies, to hold back pay rises to prevent that. Cycle.
If we just take some broad numbers here, for instance, the middle class. Let's say the middle class income, let's just use a group of them, say from 40K to 80K. If you're making 40K to 80K right now, the chances of you getting a 5% pay raise is very low. I would say only a small percentage of that group is going to get a 5% pay raise going forward. Some of them got 5% pay raises early on in the year to kind of, so they wouldn't quit their jobs, they wouldn't switch, because the job market was fairly strong. But now the job market is getting weaker. So you have a combination, and people got that when inflation first surged, you had a lot of people were angry, that they weren't, that people were demanding a high pay raise, basically. So people were getting 5% pay raises. I think now that group of people, the 40 to 80K people, a lot of those people are not going to get it. They're going to get 3% pay raises. So their next pay raise is not going to keep up with inflation. And so this is basically the consumer already tapped out and not keeping up. And as time goes by, because inflation, for instance, in Q4, we're going to end the year at January about 5% inflation, I think. So going into next year, we're going to start off the year about 5% inflation, and people are not going to get 5% pay raises. I think the recession is actually going to be, the teeth of the recession, I think, are really going to start to bite in January, because we're going to be digesting these raises, and it's going to start to bite. And so as it bites, you're actually going to see people losing their jobs in January. So why are companies going to get 5% pay raises when during a period of layoffs? It's not going to happen. So that's when your stagflation really kicks in, and basically you don't have any growth because the consumer's dead.
You read my mind, Don. I was going to ask you, what's your definition of stagflation? And as I was listening to all the stuff you're saying. Well, he's telling me, I don't even have to ask the question. You're telling me it.
Do you have any particular downside targets or timings for precious metals over the next sort of, I don't know, 1 to 5 years? Do you have any expectations for where it may pull back to if we get any issues, and where it may end up rising to ultimately over the next few years?
Yeah, this is great. I mean, people love targets. I personally don't like to go out much more than 6 months, but I do. But my caveat is, if I go beyond 6 months, I'm just guessing like everybody else. Mm-hmm. But in the next 6 months, I don't think that the lows are in, because I see this sell-off coming in the markets. Mm-hmm. If the S&P sells off from 4,200 to 3,373, that's over a 15% drop. That's a big drop. If you get that kind of selling on Wall Street, it's going to be really difficult for gold and silver to fade it and ignore it. So, silver is just hanging on here at $20. It's not going to take much for it to fall back and retest 1850. Mm-hmm. And gold is the same way. Gold can drop $50 in a day. It can go, right now it's like 1760. It can go back down to 1700 in a day. Yeah. It's not going to take much to go back and retest 1680. 1680 and 1850 have been, fantastic support levels. They both held here in July, but I don't think they're going to hold in August or September, maybe October. I don't think they will. But now, so I think there's going to be more buying opportunities basically for the miners, because I don't think the bottoms are in. So now, much lower do they go? So if 18 doesn't hold, so we went down all the way down to like 1815, I think, 1830. We got significantly below 1850, 1815, 1820, 1822, somewhere in there. I don't know. Maybe one of you guys can take a look. What was the intraday low on silver? But we didn't get a 17 handle. So if 17 doesn't hold, that basically brings 14, 15, 16 into play. We get down and have a 17 handle in silver, and people are going to basically get really nervous, and that's when you get these last selling manias. I don't think we're going to 14. 14 is, I think, the lowest handle we could see. 15, 16 is not crazy talk, but it looks to me it's probably going to be 16 or 17, but it won't stay there very long. But yeah, those are kind of bottoms I'm kind of expecting on this massive, remember I said this is going to be the worst one, the worst dead cat bounce. This one's going to go 4,200 all the way down to 3,373. That's the number we got, right? So this is going to be the worst one. And so, a 16 or 17 handle would not be crazy. I think that's something. Now, we could get lucky, right? And the 18 handle holds. I mean, that could happen. For instance, the COMEX right now is actually very positive. That's a good sign. But the silver price action today didn't basically say, oh, the COMEX looks great, silver's going to rock and roll up to 21 today. It didn't happen. So the COMEX really isn't showing itself yet. So maybe, I don't know, maybe the COMEX will give us a little bit of support here at 20. I mean, at 1850 again. So now let's go over and look at gold. So again, I talked about how gold can easily drop $50 in a day. We know that. We can go back down to 1700 in 2-3 days. Not going to take much to get back down there. You know, if the market sell off huge. So then we go back and we retest 1680 again. We've tested it 3 times. Okay, hey, you guys are the chart guys. Okay, bring up the weekly. Actually, you could actually even bring up the monthly gold chart for the last, I don't know, 5 years. When you guys bring it up, and let's look at 1680 and look at the three times the held. Go 1680 and go all the way to 2020. Look at that. Whoa, no, it's 2020. You don't need to go, 20, there you go. Look at how many touches there we got there. 1, 2, 3, 4, and then 5, 6, 7, 8, 9 going back 2020. Look at that. Look at go all the way back to 2020. Look at all those touches on 1680. But look at the last 4. Look at the last 4. My goodness. That's a scary level if it doesn't hold, right? Hey, you guys are chart guys. You tell me it's a scary level if it doesn't hold.
1680 is a level that I've been pointing out to subscribers and followers on Twitter for quite a while. I totally agree. 1680 is absolutely critical. And you know, until we get through that 1850 congestion area, it hasn't proven anything. So, you know, I completely agree.
I mean,
you know, even if we get the breakout from this little wedge that's forming,
even if you don't believe in technical charts, when you look at this one, it's got to go, oh my, it's got to go, wow. Your jaw's got to drop when you look at this chart. And so if 1680 doesn't hold, there's no doubt in my mind we get a 15 candle, right? I mean a 15 handle. There's no way we go through 1680 and don't get a 15 handle. So where do we go? If 1680 doesn't hold, where do we go? I say 1575 is our best chance at holding. So you the chart guys, you tell me, is 1575? Do you see support at any support at 1575?
There is a level probably around about in there somewhere.
So 1565. So, okay, so 1575 might not hold. We go down a little bit lower, 1572, 1560. So basically, we're going to crash from 1680 all the way down to 1570, 72. That's a big drop.
But for how long, Don? Because I'll remind you. Look at March. Look at the candle at March 2020.
We're the time. It's not going to stay down very long.
Yeah,
but the point is that it's going to go there. It's not going to stay. So okay, so that's a big drop. If that takes that down there, where does that take the HUI? So if 1680 gets taken out, where does the HUI go? I think the HUI goes to 170 to 180 if 1680 gets taken out. So there's going to be buying opportunities.
Yeah.
We're not going to go to
what's going to happen. It's going to happen so fast. People are going to be so fearful. People are going to be shell shocked, and not a lot of people are going to be ready to buy that dip because
no, they're not. No, it's going to be like a 1 week to 1 month type of scenario.
It'll feel like the end of the world. Like
it'll feel like
headlines.
Oh yes. Okay. So yeah. So the HUI, I think we're going to go down, you know, if 1680 doesn't hold. Okay. So 1680 doesn't hold. We basically drop $100. We drop $100 all the way to 1570, 75, 1560, 1575, somewhere in there. And then we wait. If that doesn't hold, I think it will. I think the 15 handle is going to hold, but that's going to be nasty. I don't think we're going to the 1400s. So we're looking basically, if 1570, 75 doesn't hold, we're probably looking at maybe 1525, somewhere in there. That's kind of worst case scenario. That basically takes silver and the 15 handles. These are worst case scenarios. But I'll tell you, when you look at that 1680, you got to get really, really nervous, thinking if that 1680 doesn't hold, we got a big problem here. Or we have a big opportunity, depending on how you hold it. Okay, so now,
Don.
Yeah.
Let's say right now, let's say the U.S. equities, they rally, gold doesn't get dragged down. Gold goes up to 2300. And so now let's say the SPX does get dragged down, but now you're not getting dragged down from 1700. You're getting dragged down from 2300. What's your low? Then we're not looking at 1400. Then you're gonna have a retrace.
No. I got to interrupt you there. We get to 2200, you can forget about any type of sell-off or any type of correction.
Okay.
Once you get to 2050, we won't see 2050 again for 2 years.
Even if the SPX drops 30% solid. And
No, because you're not going to 2050 until after the bottom is in on S&P.
Well, I'll show. I have some charts.
We're going down right now on the S&P to the bottom. We're going down now. So gold's all the way down. Gold's, down here at 1780, going down lower. Gold's going to go down now. And once it gets to 2050, it's basically, that's it. That's the next run. So you can look at the runs, right? If you look at the big runs, we want to basically now look at the monthly chart. If you look at the big runs, well, actually weekly works too. If you look at the big runs, we're getting ready to do the next one. Okay, this is good. So basically, I want to back up further. I want to go all the way back to 2007. Okay, so there's your run from, you can go 2007 actually all the way. There's your 2008, but that wasn't much of a pullback really. You can go all the way back down. Yeah, right. Yeah, all the way back. Yeah, way back 2007. Look at there. Yeah. I mean, you can go back. So that run, it lasted a long time. Jeez, it lasted a long time. Right. So that was the run. And then we had a kind of a fake run in 2016. Really fake. I mean, it was basically nothing. It was a nothing burger, right? It was a nothing burger. It was just showing us, what's coming. And then 2019, actually, it's like gold anticipated COVID. Gold broke out before COVID. And that was your second fake run. So we had fake run number 1 in 2016, and then we had fake run number 2, 2019 to 2020. Now, when we get to 2050, once we get to 2050, there's your next run. And that next run is going to be big. It's going to be historic. It's going to be epic. It's going to be generational. You're not high enough.
Well, we know the future, Don. All you have to do
There
is
you
look at
go.
gold.
There you go.
Look at gold in other currencies.
That is the run of the run of the run. That's your generational run. That's the one I've been waiting for since 1991. That run is going to make the miners do somersaults and head flips and back flips and everything you can think of. Now, I personally, here's where it gets kind of nuts. And again, I'm telling you, once we get to 2050, it's on. It's basically on. You can that handle. You see that handle that we're in right now? We're not going back to that handle. Forget about that. We're off to the races. We're jumping above that handle, and again, we're gone. So now, as a gold and silver mining analyst investor, I don't care about anything above $3,500 gold. Now, it probably is going to go higher, but as an investor, I'm going to make so much money from $2,000 to $3,500. I don't even value these companies that high. I'm one of the few investors that values companies on future gold prices. I value companies at $2,500 gold because the upside is so huge. If gold goes to 2,500, these miners are going to go up 2x, 3x, 5x, 10x. So as far as I'm concerned, I don't even value them above 3,500 because it's just the numbers are insane. They go so high, it's like Bitcoin returns. They make your head spin. It's like, wait a minute, what if a miner's at 10 bagger, at 2,800, what is it at 3,500? Those are numbers that you can't even wrap your head around. Oh, man. Well, I only value them at $2,500 gold, And then I use $100 silver because it's a round number. But if you take the GSR, so I believe, for me, the minimum price for gold and silver is $2,500 gold is my minimum, right? I think $2,500 is a very conservative number. So if it's conservative, let's take it to 3,000. If gold goes to 3,000, you take a GSR of 30, that takes you to $100 silver. Now, is a GSR of 30 crazy talk?
No.
Back in 2012, the GSR got to 38,
right,
and silver was only at $50 for a month. So this time, if silver stays, say, above 80 for 2 years, do you really think the GSR is going to stay at 38? I don't think it will. I think it's going to keep shrinking and shrinking and shrinking. I think a 30 GSR at 3,000 is a legitimate forecast. So that takes your gold, your silver to 100. Now, I think that $2,500 silver is conservative. So that takes $3,500. That brings $3,500 gold into play. So if you go to 3,500 gold and you get a 30 GSR, what does that take silver? Well over $100. Well over $100. So let me do the math on it real fast.
While you're doing that, I'm just drawing the chart.
I don't know why, but I always have trouble.
There's your path for the gold silver ratio down to 20 or so.
Yeah. Gosh darn it. I'm having trouble. Side by side, exit full screen. Maybe that'll do the trick. Yeah, that did the trick. Okay, 3,500 divided by 30. Better not be 150. No, it's 115.
Yeah.
So 115 is kind of a legitimate target. But if the GSR, a lot of people think the GSR is going to shrink to 15 or 20. So 115, I think, is a fairly legit target. 150 is not crazy talk if you get a tighter GSR.
Well, you know what? The way I see it, Don, is wherever it goes, whether technically, let's say it goes to 30 and then it goes back up, or 15. Right now, on a historical perspective, you're at the low risk of the range. Yes, let's say the SPX goes down and silver gets sold off to 15 and gold drops, but you're still in a low risk, high reward opportunity if you give yourself some time, right? So you could either wait for silver to
yeah. One thing I want to emphasize here is that we are basically predicting kind of a 6+ sigma event. This is kind of a once in a generation event. So the risk reward isn't low or good. I mean, it isn't good per se, because we are basically kind of being visionary here and predicting the future, and basically saying we're expecting this, this once in a lifetime, once in a generation, 6+ sigma event. It's almost like, remember I was saying that the returns are like, makes your head spin. So anybody that's watching this, before you get, super excited that the gold's going to 100, 115, silver's going to 100, 115, and gold's going to 2,500, 3,000, 3,500. These are just, speculative bets, if you will. And I want to make one other point here, is that what drives gold and silver is a systemic financial risk. People don't buy gold unless they have to. So the chances of a financial systemic risk event is very low. It doesn't mean it's going to happen. The people that are investing in gold and silver miners is less than 1%. It's actually like 0.001%. And the reason why it's so low is because this is speculation. This is outlier. Now, I've made arguments today basically saying that this is probably going to happen, but it's still a total speculative guess on my part. It might not. I think it will, but again, I just want to make that point clear because you said that this is a low risk, this is a good risk reward bet.
Of course, from the risk reward point of view, it's also just worth mentioning that the gold to S&P ratio is turning gradually in favor of gold, and it's always also worth remembering that over the last 20 plus years, gold has actually outperformed the S&P and given greater returns since the year 2000 than the S&P has. So it depends on the timeline that you pick. Of course, you can pick and choose your time periods, but if, like me, started investing 15 or 20 years ago, then you would have been better buying gold than you would have buying the S&P. So gold tends, in my view, sort of acts as a bit of a barometer, and it kind of sits there measuring loss of purchasing power.
Yeah.
So if your purchasing power is going to be eroded very rapidly, then gold will reflect that.
I'm glad you brought that up. So yeah, I mean, it's possible if you buy physical gold or physical silver that you'll outperform the S&P and you'll do, somewhat okay. But that's not what I do. I do gold and silver miners.
Yeah.
So if silver never gets above $35 or never gets above $30 for say the next 2 years, your returns are gonna suck. They're gonna be terrible. My whole bet is silver trends over 30 to 50, 50 to 100 or higher. So I'm a total speculative gambler betting that this is going to happen. I basically say that you should own physical silver and gold to diversify this speculation in the miners. But don't expect to make money in miners. Expect to lose money in miners. It's a very speculative game here. If we're right and this happens, we're going to make so much money if they allow us to. It's going to be kind of weird. It's going to be strange. It's going to be generational type stuff. I mean, to this day, if you go back and look at the returns that people made in 1980 and 81 on the miners, people to this day are still scratching their heads. I mean, there were stocks that were up 47,000%. That's how giddy it got. I mean, these are Bitcoin type returns that people could see. And so, I mean, you could see the big ones. You could see Barrick and Newmont be 5-baggers, which is kind of crazy stuff. That's basically what we're going to see here. If they're 5-baggers, you can expect what the juniors are going to be. There's going to be 10, 20, 30-baggers all over the place. Just some giddy stuff. And then you're going to see some 10,000, some 20,000 returns. So, by the way, 10,000 is a 100-bagger. So when I say 47,000, that was a 470-bagger. So, so yeah, 100-baggers, we're going to see a few 100-baggers. I don't know if we'll see a 470-bagger in this run. Probably not, but we will see a few 100-baggers, 10,000% returns. That's going to happen. And we're going to see a lot of 50-baggers if we hit the numbers. So this is just total. If we're right, we make a fortune, but we might not be right. We might sit here and be, 3 years from now, still waiting for $35 silver, So I just want to make that clear to everybody that's watching.
Well,
don't say it. No.
Well, look, we do weight of evidence, Don, and if you just take one chart and then you have a decision, yes or no, yes, you could say speculation 50-50, but the way we do it, SPX divided by PPI has broken down. Last time it did it, 2000 and the 1970s, check. That's a huge check. DXY broke down versus PPI, check. Gold broke out in June of 2019 above that huge base. It didn't break out that base for no reason. Check. A whole bunch of checks, and that changes when you do from a scientific approach. Your probability right now is skewed that there's a capital flow shift, leaving growth stocks because of the inflation, whatever narrative you want to like, towards assets where. So for me, the probabilities, of course, we're always waiting for the breakout, silver to go up above 28, and then to look at the higher levels. But for me, the transition in capital flows has started already. It started in June 2019. We're super early then. But as soon as gold breaks out versus the SPX on that chart, overlay the silver chart to the gold divided by SPX, it's practically the same chart. So gold's going to open the gateways
Yeah. So I,
to everything.
yeah, so I basically gave people a really long disclaimer on, you know, the risk levels, right? So now I'm going to tell you kind of what I think is going to happen. I'm actually giddy at the expectation that gold's going to 3,000. I mean, if I go back to 1980 and look at everything that's happened since then, as far as I'm concerned, the probabilities of gold going to 3,000 are actually quite high.
Yeah.
I gave a disclaimer. I told you,
I know.
we got this is going to be a Six Sigma event. But in my opinion, the reason why I basically buy the gold and gold miners is I actually think the probability of gold going to 3,000 is actually high, likely. And if you look at the technical data, you look at the technical numbers that you just mentioned, a few of them kind of support it. Even though it's hard to predict a Six Sigma event, I think that if there was any time in history that you could predict one, it's now.
Well, gold hasn't put in that huge base for nothing, and it hasn't built out that handle for nothing. So whatever happens in the short term, the long-term technical chart structure, the ratio charts, the capital flows, whichever angle you look at it from, there's so much evidence building that something is getting very, very close to occurring in the precious metals market, that we can't ignore it. We just cannot ignore the weight of evidence that's starting to build.
So we could be getting tricked here. And the reason why is because the technical charts are set up so beautifully in tandem with the macro environment. So when you combine them both, like I said, I think the probability looks good. It looks great. But simultaneous to that, we are predicting an outlying event that's kind of weird. It's kind of like, in hindsight, if we're right, we'll basically say it was obvious. It's like the Michael Burry thing in 2004-5, where he predicted, the crash in the mortgage-backed securities, and he bet $100 million on that event, and he was way ahead of the curve, and he basically saw it. He predicted the future, and he was right, and it was a Six Sigma event. I kind of feel that this is very similar to the Burry call in 2004-5. It's very similar to that. We look at all the data, and the data basically says it's highly likely. And Burry, he literally said this. He called it a certainty. So basically, he predicted a Six Sigma event as a certainty. I'm not saying that. I'm not going out on a limb like Burry and say it's a certainty. That was my favorite line in that book. I mean, in the book and in the movie. It's a certainty, right? I don't consider this a certainty. And for one, there's a couple of things to consider here that prevent it. Number one is you got to have systemic risk. Without systemic risk, no one's going to buy gold. You got to have the big money. The big money's got to say, holy crap, I got to buy gold. There's got to be a reason for the big money to move into gold, to move gold to a new all-time high. The last time it happened, the fear trade was 9/11. 9/11 basically, and a combination of basically the dot-com era popping caused gold to trend from 250 to 1900. That was the fear trade that lasted 10 years, lasted a long time. And then MMT put the genie back in the bottle and put the fear trade back in the bottle. Now, I believe that in March of 2020, the fear trade came back to life for 1 month, from July to August. It only lasted 1 month, and then people go, calm down, the Fed's got this. And the Fed started printing money like nuts, like crazy. And the fear trade basically went back in the bottle. I think the fear trade will come back out of the bottle. And the third time's the charm. And I think this is going to be the ultimate fear trade. And this fear trade is going to last 2 years. The last one lasted 10. But this one's going to last 2 to 3. But it might last 10. Who knows? But I think it'll last at least 2 to 3. And when this fear trade happens, see, the only way we can talk about this is if we gave that big, long disclaimer, right? So the fear trade, when the genie comes out of the bottle again, I think gold will go up $100 in a single day. And once it goes up $100 in a single day, you won't be able to stop the trend. The trend will be, you know what I mean? It'll be on a chart, an upward trend. you won't be able to stop it. It'll almost be like the S&P 500 from 2009 to 2016. It just straight up, right? You couldn't stop it. There was no correction. The first correction was 7 years later. You might have a similar event where it takes 7 years to slow gold down, but I think it's only going to take 3. But you're just not going to be able to stop the trend. There's going to be too much demand. People are going to buy the dip.
Okay.
I think that
guys,
is maybe a good place to wrap up the interview. I think we've covered a lot of ground there. We've covered
that was insane,
general
man.
equities. We've covered fundamentals. We've covered gold, silver, Six Sigma events, and yeah,
Both sides, and we covered both sides of the gold valuation.
Yeah,
you know, both sides. Will you make money? Will you not make money? Kind of thing.
Yeah, and the possibility that we're sat here a few years' time with silver still trying to get to $35 as well. So let's hope we've not got you on here in a few years' time, still waiting for the breakout.
Don, can you tell everybody there where they can find your stuff? I used to be a member of Gold Stock Data. You gave me a membership a while back, and I just love going through all the data you have there. It's insane there.
Nice. So yeah, can you guys put me on your calendar for like January 5th?
Of which year?
This 2023, January 5th. I mean,
5th.
we don't want to do it. We don't want to do it on the 1st, of course. I mean, you guys are going to still have a hangover. The 2nd, you'll have a hangover. The 3rd, you'll have. So the 4th or 5th is the earliest we can do it. So
I think the 5th might be a safe bet. It'll take a few days.
Let's go for the 5th, and we're going to basically know the inflation number. We're going to know the gold number. We'll be able to refer to this interview. You know, maybe take some notes, right? One of you guys take some notes about everything I said, and let's review what I said in January.
Yeah,
we'll do that.
I'm going to watch this interview again. Thank you, Don, for your time. Super appreciate your time. I appreciate it.
Hey, Patrick and Kevin, I really enjoyed it. You know, third time's a charm kind of thing.
All right, man. Take care, Don.
Thanks for joining us, and don't forget to hit the subscribe, the like, and the notification button for more.